Welcome to the Profit Playbook. I'm Tracey Metcalfe, your host today, and I'm joined by Ed Gooderham, one of the other partners here at Green & Co. In our first series, we talked about exit planning. Today, we're going to look about exit planning with the ever-changing tax landscape. Welcome, Ed. So today we're going to look about the changes in the tax system and how they're going to affect exit planning. So can you let us know a bit about the changes from business asset disposal relief, what the changes are, and how that's going to affect businesses in the decision about selling their business?
Yeah, so again in the budget there's a few announcements this year and last year. Business asset disposal relief is the biggest relief that we have for entrepreneurs and business owners. And that at the moment is 14% capital gains tax on the first £1 million that you have as a gain. That's increasing to 18% after April this year. Again, on the first £1 million. Anything over those limits, you pay the normal CGT rates, which at the moment is 24%. But only a few years ago, that was 28%. So that could change at any point.
So it's like they're bringing the two in almost in line, or could get to that point?
Well, we used to have CGT rates of 18% and 28% previously, so there's a 10% gap. The government, the last Conservative government, reduced it to 24%. I thought at the time partly to help people selling their properties and other things. But it's interesting that the current Labour government haven't changed it and haven't increased it. A few years ago, the Office of Tax Simplification actually wrote a paper about putting it the same rate as income tax rates, so 20%, 40%, 45%. Now that hasn't happened for various reasons, and lots of different speakers out there say that it won't go to those rates because it doesn't make commercial sense. But certainly it might not stay at 24%. And the biggest issue when you're selling a business is to have certainty about how much tax you're going to pay. I was actually chatting to a client earlier today who was looking at going the EOT route, Employee Ownership Trust. And that was brilliant before the budget last year, where you had 100% capital gains tax-free on the full amount, and they were selling for £4 million. So 100% tax-free, that's all changed now, so they get 50% tax-free. So that's still very good, but the other 50% is all taxed at 24%. Now, fortunately for him, it's the same levels as BADR, so there's not much difference between going either route. But for other clients, it can make a huge difference depending on the size of the exit.
Yeah, so do you still recommend selling at this point in time, or should they hold back?
So in terms of exit, it's about what do you want to achieve yourself. Do you want to finish working and come away from your business, in which case you want an exit? Now that could be the fact that you might want to put a management team in place so that you can do less hours, less work, and therefore still own the business, still operate in the business a little bit, but the management team run it. Now, that's a good way to carry on owning the business, because obviously you get relief for inheritance tax on business property relief up to £2.5 million, which you obviously increased just before Christmas. Yeah. So that's a better way, if you want, to pass the business down to the next generation, because you've got £2.5 million that you can pass down. But obviously you still own the business, you've got the stresses of owning the business, and some people just had enough and they want to exit. So if you want to exit, then you've got to look at, well, what's the best way to do it? And like you just said then, sometimes people want to have an earn out or just take an income from it, and therefore they don't want to pay all the tax up front, which you would have to do. If you're over £1 million, then you've got 24% you're going to pay on day one. If you just want to leave it there in the background with a load of cash in and just take a dividend every year for yourself and your spouse, you could be taking nearly £100,000 a year and only paying 10.75 after April, which is a lot better than 24%. But the only issue with that is obviously you're not getting the BADR relief for the 14% at the moment, 18% after. But again, they're higher than dividends. So it all depends how soon you need the money, what your long-term plan is. I got some clients who retire when they're in their 40s or 50s.
Oh, I wish.
And therefore, they might actually want an income stream. Other people want it obviously to go and pay debts off or just to go and enjoy themselves, in which case they have to take all the money and pay the capital gains tax.
So do you always look at the personal circumstances of each individual before obviously making these tax decisions?
We try. We try to look holistically at the client, at their situation, what they're trying to achieve, what their goals are for themselves, their family, and see what's best for them. And therefore, what if they need cash and when they need it would probably dictate if they're using the capital gains route and getting some tax free under BADR, some paying capital gains tax at 24%. The other big issue is obviously in exits. Sometimes you might be selling to somebody else and they haven't got all the money to pay on day one. So therefore you might have deferred payments. And therefore you're waiting for some of the money in the future anyway. And there's no guarantee of getting all your money, as sadly has been the case in a number of people when they sell their business. So it's worth thinking about different options for how much money you need now, if you want to put some into other investments even. So I've got some clients who they're looking at making big capital gains on selling their business, using the £1 million BADR, £1 million they can have in their pockets at 14% this year, 18% like I said. The other money at 24%, when they get that, they're thinking about, well, actually, if I don't tax it all on day one, I'll come back to that in a minute, but actually tax it when I receive it in the future years on deferred payments, I could hold over some of that gain and invest it in things like EIS investments, where you can actually roll over the gain into a new asset. So that works for some people.
Ed, can you just explain about EIS, what that is for people who don't know what that is out there?
Yeah, so EIS is an enterprise investment scheme, which is a government-backed, tax incentivized investment. So you actually get 30% income tax on the money you put into an EIS, and you can also roll over gains, hold over the gain in the EIS, so the value of the investment you put in. So it's very good for lots of people who are looking at exiting their business. They're obviously used to some level of risk in their life because they've run a business, so they're more open to more risky investments, which EIS are. And then they like the fact that you get BPR relief, so business property relief for inheritance tax on the EIS investments. So it works for two reasons. One is you're holding over the gains, you're not paying your tax on your gain. And then you also got the fact that you've taken something that was a business property relief asset, like having shares in your company, putting it into cash, and then putting it into another investment, which is good for inheritance tax, another BPR relief.
So a double help.
Yeah, and you also get 30% income tax as well, depending if you've got enough income to use it all. But yeah. So yeah, it's very efficient for lots of clients. Obviously, we can't give advice on where they invest it in AES. We refer to IFAs to do that.
Okay, so you mentioned earlier about the timing of when you pay tax. Can you just clarify what you meant by that?
Yeah, so normally if you sell your business in a tax year, you'd normally pay the capital gains tax on the following January. Now that could be the full amount, even though you're not getting the payments for a number of years with deferred payments. Right. And there's a very famous tax case that said that if you wanted to get capital gains tax treatment, you have to tax it all on up front, even if you've got the deferred payments. And that's the only way you can get BADR relief. So if you're selling a business for less than £1 million, that's the best way of doing it, unless you're looking at taking the money over a long time by just leaving it in the company and taking dividends. Because obviously, like we said, if you're going to take less than 50,000, that's a low tax threshold. But yeah, so if you've got the money coming at over £1 million, so you're going to pay capital gains tax at 24% on some of it, some people might choose to defer paying that capital gains tax until they receive it. The only worrying part with that is you don't know what the tax rates are going to be in the year you receive it.
Yeah, because it's ever changing. So
the benefit of taxing it all on day one, or in the year that you actually sold your business, is you've got certainty about how much tax you're paying. But again, like I said, some people might do EIS investments in those years to mitigate some of those gains and hold them over for the future.
So you talk about it can change at any time.
Yeah.
Is this something that people always need to do? Business owners review their plans regularly?
People should be reviewing their plans and having an exit strategy, so you know what you're working towards. Are you actually trying to grow your business, create a management team that takes the pressure off you, and therefore if you need to step out, you can, but it also helps you concentrate on your business? Whereas if you haven't got that exit strategy, you don't know if you want to sell, if you want to pass it down to the next generation, if you want to pass it to the staff even, either with an EOT or a different way of doing it, then what are you doing? You're just going along, getting tossed around by whatever happens in the business. And the problem is businesses can consume people, as many of your clients and my clients will tell us, that it's hard work sometimes being the boss at the top. So therefore, actually having clear goals and knowing where your direction is really helpful and gives a lot of sense of calm and peace about it. So every client, I always say to them, what's your exit strategy? It might be they want to run the business for the next 20 years. Okay, what does that look like then in 20 years' time when you sell it? And how do we get from here to there? And that's the exit strategy. But it might be a long time in planning.
Which is why we regularly meet with our clients and ask them, what are their goals each year?
Yeah. And sadly, sometimes life things happen. Like I've had clients who get suddenly ill with a diagnosis and suddenly the whole
plans, doesn't it?
And that happens as well. So it's always good to try to keep the business in a position where these things can happen. And also you might get people come along and want to buy your business every now and again. Now, your business might not be in the state ready to sell. So ideally you want 2 or 3 very good years showing nice growth in profits. That's the optimum time to sell it. But again, these things don't always happen at the right time. Look at COVID a few years ago. Suddenly, every business was affected by it. Some had massive profits, some had big losses, sadly. But that wasn't anything the owners could change, but their exit strategy might have been to sell around that time. So we need to bear these sort of things in mind and just keep talking to our clients and keep a narrative on what the exit strategy is and what the plan is.
So with that in mind about possible selling, so it's still important to build value in your company or business?
Yeah, so most clients are always trying to grow their business and trying to make sure that they're as profitable as possible. And therefore, the big thing really is to keep monitoring that, looking at your profit margins, looking at what you're doing, what your plan is, what you want, how you want to grow, and therefore, how you're going to achieve that growth. Now, as most business owners, they can't do everything themselves. So they need staff around them, they need teams of people to help them achieve that. And as businesses mature, you often see that they have a good team behind them, and then at some point they could either sell it to their team if they want to retire, or if they've got another generation coming through, things are ready for them so that they can grow into that role.
Yeah. Thanks, Ed. So if you want to just summarise before we wrap up a few key points that people can take away.
So obviously having an exit plan is a key point, knowing what you want to achieve and what you want to come out with from selling your business, if you want to sell, or if you're looking some clients just to wind it down and have an exit route of either capital gains with a solvent liquidation or leaving the money there and drawing it over a period of time. The other big issue is just having that certainty, knowing how much tax you're going to pay and making the choices of, do you want to pay all that tax now, or do you want to defer some of it with deferred payments?
Okay, thanks, Ed.
Thank you very much.
Well, I hope you found that really useful today. And if you ever have any more questions or queries on exit planning, please do get into contact with us. Please also like, share and subscribe. And thank you for listening. And I look forward to seeing you again.